This is a sequence of 3 lectures where we do intro. That's today's discussion. After we go over the basic options, introduction, the second lecture in the sequence would be stock plus options, hedging. And then the last one would be advanced options. So this is our version of intro to options. You know, and option contracts do indeed exist outside of the securities industry. Outside of the securities industry, we have contracts with 2 parties, and the 2 parties to a contract, one of those parties pays consideration, the other party receives consideration. You know, for example, I wanted to buy a car on a when issued basis. It doesn't exist yet. And they said when this car comes out, it was going to be a suggested retail price of 24. I didn't believe that. And so I went to the dealer and I said, listen, I'd like to give you $3,000. I'd like to pay you a premium of $3,000. He says, what's the catch? Nobody gives you money unless there's some kind of catch. I said, for this $3,000, I want to have a choice to buy or call away from you the car at 25 grand. And he said, well, Dean, if the manufacturer suggested retail price is 24. I said, well, indeed, and I wouldn't exercise my choice to buy at 25 if I could buy it in the open market at 24. You would just keep the $3,000. He says, okay, do I want something in written form from him? I most certainly do. Now, in our time together, it's not going to be an underlying interest of automobile. But in my example, the car dealer has received the premium. He's obligated to sell the car to me at 25 grand, the strike price. And best case is I don't make him perform on the contract and he keeps the $3,000. Please note, his gain is my loss. You have half as much to learn when that dawns on you. This is not, as we're looking at the screen, a box with 4 squares. I call this the options matrix. Every one of these quadrants somehow relates to another quadrant. I would highly recommend you get a sheet of paper and fold it in half. Fold it in half again. We have 2 types of contracts, calls and puts. You can either buy them or sell them. And so today's, this evening's lecture class is about those 4 basic positions. We also have put contracts outside of the securities industry. You know, I was getting ready to lease a high-end automobile, and the car dealer told me that at the end of the lease, the car is going to be worth $60,000 or more. I said, really? You know, you and I have opposite expectations about the price of this automobile. You say 60 or higher, I say less than 60. How about I give you $4,000? He said, what's the catch? You know, people don't give you money unless there's some kind of catch. He says, I say, for the $4,000, I would like you to stand willing to buy that car for $60,000. And he said, well, Dean, you know, what if the car is not worth 60,000? I said, well, if it's not worth, you know, if it's worth $60,000 or more, I'm going to sell in the auto trade. I'm not going to stick it to you. He said, okay, do I want something in written form from him? I, car dealer, agree to buy said vehicle for $60,000 in consideration of the 4? The answer is yes. That's why we call the short version a writing the contract. Because writing the contract is what obliges you. Let's say that at the end of the lease, the car is $40,000. And he's sitting there on his lot. He says, I wonder if Dean's going to show up today and make me perform on that contract. I wonder if he's going to show up and stick it to me, put it to me, make me buy at 60. The answer is yes. I'm going to say, here's the car. Where's my $60,000? He says, Dean, you're making me pay $40,000 for a car that's only worth $60,000 for a car that's only worth $40,000. I go, yeah. You didn't want to do that. You shouldn't have collected the premium. He said, well, I'm going to lose 20 grand. I go, no, you get to keep the, you know, 4. You're only going to lose 16. He said, wait, you're still good at my loss. I said, well, because your gain is my, you know, your loss is my gain. Again, these are 4 basic positions. Now, this evening, we'll be adding to this matrix. We'll be adding our max gains, our max losses, all kinds of good stuff to the matrix. And we get all done, as you can see here, we get all done this evening, this is what your matrix should look like. And the good news about the matrix is if you memorize the matrix, And I ask you, like, for example, what can you tell me about a short put? You say, Dean, when you're short a put, you've received the premium, you're obligated to buy the stock at the strike price, you're bullish, the max gain is the premium, max loss is when the stock goes from the break even to zero. Your break even is strike price less premium. You might not have any clue what you just said, but it's technically correct. Right now, you intuitively already know that if I have a choice to buy the car at 25, the worst case is I don't exercise the contract and I lose $3,000. You intuitively know if I'm short the call, the car dealer, the best case is I don't make him perform on the contract. He goes neener, neener, neener. He keeps the $3,000. I got to think like my insurance company, right? I pay him a premium. As long as I don't file a claim, they get to keep the money. Intuitively, you knew that if I had a choice to sell that car at 60 and the car is 40, I'm going to make him perform on the contract. My worst case there is I paid $4,000 and the choice to sell at 60 doesn't make any sense because I can sell it at 70 or 80 in the open market. And intuitively, you knew that if you're the put E, we're going to have putters, we're going to put E's, you understood that if you had an obligation to buy at 60 and it's at 40, somebody's going to make you perform. All right, so we have two types of contracts. I think a lot of people get hung up because they think there's a zillion things going on, and there's not. There's only two types of contracts, calls and puts. And every option contract has two parties. As we said, somebody who has paid the premium. Now, it's kind of like learning a foreign language. And so sometimes I'll say, what does it mean to say you're long an option? And somebody will say, well, Dean, that means you're the buyer. I said, well, what's that mean? You say that means you're the owner. I say, what does that mean? You say that means you're the holder. I said, that's a mental cul-de-sac. That isn't really getting you anywhere. What will they say on the test? Whatever you're not prepared for. You say, Dean, that means you did an opening purchase. The thing that you've got to get to on the exam is when you hear the word long, buyer, owner, holder, opening purchase is the word choice. And then you got a 50-50 chance. You either have a choice to call the stock away. If it's a call contract, a choice to buy the stock. Or if it's a put contract, you have a choice to put or sell the stock. It doesn't matter whether you want to have a choice to call the stock away, a choice to put the stock or sell the stock. Doesn't matter. Choices cost money. You're going to have to pay a premium. You should definitely know, test question, an opening purchase is used to establish or add to a long position. They'll say, which of the following types of orders would be used to establish or add to a long position? And you'd say opening purchase. Every contract has two parties. I say, what does it mean to say you're short an option? You say, Dean, it means you're the seller. I go, what's that mean? You say, that means you're the writer of the contract. I would say, what's that mean? You say, that means you did an opening sale. That's a mental cul-de-sac. That doesn't get you anywhere. When you hear the word short seller writer, what you've got to get to is obligation. Potential victim is the way I think of it. And nobody is going to agree to be a potential victim unless you give them some money. And so if you have an obligation to sell the stock, that would be a short call. An obligation to sell the stock at the strike price. If you have an obligation to buy the stock, that would be a short put. So what will they say on the test? Will they say short seller writer? They'll say whatever you're not prepared for. Types of orders are very testable. If they say on the exam, what type of order would be used to establish or add to a short position, you'd say an opening sale. I kind of think of like the casino here in Vegas, right? When I go into the casino on Friday night, I go to the cage and I do an opening purchase. I buy my chips, right? From their perspective, it's an opening sale. Then I go play out there on the casino floor. I play all the games I want to play on a Friday night. And when I'm ready to go home, I do my closing sale. I cash in my chips. Right? I say color in. That means I'm going home. And what I'm hoping is I've got more money in than out. From the casino's perspective, my opening purchase is their opening sale. My closing purchase or my closing sales, their closing purchase, right? So types of orders are pretty testable. So the first one we're going to be talking about is the call contract. And we said a call contract has two parties. Even outside the securities industry, contracts have two parties. Somebody who's paid consideration, somebody who's received consideration, right? You guys have paid a premium. You are long a basic options class. I have received the premium. I'm short a basic option class. If I didn't want to be obliged to deliver this class to you, I shouldn't have collected your money, right? So in a long call, as we said, we're going to have the choice to buy the stock at the strike price. And a short call, we're going to have an obligation to sell the stock at the strike price. What I'd like you to be good at, if you can get good at contract specifications, in other words, you're not fumbling around, that a short call is an obligation to sell the stock at the strike price. And you get good at tracking money, you're going to hope that you had, 125 option questions rather than the 20 you're most likely to get. As I said, a lot of people think there's a lot of things going on. There's not. There's two types of contracts, calls and puts. You can either buy them or sell them. So we have four basic positions. There's our four basics. When you're long a put, you paid a premium. You have a choice to sell the stock at the strike price. So whether you want a choice to call the stock away or a choice to put the stock, choices cost money. And we can't have putters unless we have put-ees. Why not get paid to do something I'm already prepared to do? For example, Apple is at 168. And I might sell a 170 put, oblige myself to buy Apple at 170 when Apple's at 168. And let's say I get 4 points for that. And then you stick the stock to me. I go, well, thank you very much. I wanted the stock anyways. If I buy Apple at 170 and I got 4 points to do so, I end up paying 166. Shorting a put is a way to get the stock at less than the current market price. So one reason you might sell an option contract is to get paid to do something you're already prepared to do. If I'm already prepared to buy the Apple and somebody will give me some money to do so, I say thank you so much. Again, there's our matrix we'll be working on and this evening. It's like learning a foreign language, and they say when you dream the foreign language, that's when you know it. So here are the terms of a standardized option contract. Let's just put an answer set up here. Can you guys see my screen where I'm writing? Yes, no, maybe, nobody's there.
Yeah, I can see it.
Okay, cool. The other reason the nomenclature vocabulary is testable is because it helps us qualify you. In other words, if you tell me that you want to trade options, and I say, well, what type of contracts are you interested in? And you respond by saying, well, Dean, how many types are there? Now, we're not off to a good start. You say, Dean, I'm interested in call contracts, or I'm interested in put contracts. It's kind of like we're going to play a game of chess. If you say, Dean, I'm interested in Apple call contracts, that would be the type plus the stock. The type plus the stock. Apple calls is a class. Apple puts is a class. But if you're asking me to get you a quote, you say, Dean, I'd like a quote on Apple calls. I go, well, gee, Philip, there's lots of them. Which ones are you interested in? You say, Dean, I'm interested in a quote on an Apple 170 call. I go, well, Philip, there's lots of those. You're interested in the Decembers, the the Aprils, the Augusts. Test question, the series is the most complete description of an option contract. They'll say on the test, the most complete description of an option contract is A, type, B, class, series, ding, 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 ding. That's everything you need to get that premium, get that quote. That would be the underlying, the expiration, the strike, and the type, everything. Kind of a trick question. I'm your supervisor and I say, hey, Suzanne, I see that you've filled out this order ticket and it says Apple 170 call, that your customer wants to go long an Apple 170 call. Which one? You don't have a complete description on the order ticket. To fill out an order ticket, you got to have a complete description. And she goes, well, December. I would say, Susanna, do you have permission from the customer to make a decision about the expiration month? Because unless you have discretionary authority, that needs to come from the customer. Right. So we can't be making decisions about, the month and the strike unless we have discretionary authority. All right. So let's go through this description here. One. So that's important. One means somebody is in control of 100 shares and somebody is a potential victim on 100 shares. Each option contract governs 100 shares. The technical name for that is the multiplier. Now, the reason that's important because on the test, they might say 3 contracts or 7 contracts. And you say, okay, 7 contracts. Okay, so somebody's in control of 700 shares or somebody's a potential victim on 700 shares. Now, our time together is a buffet. And the buffet, if you don't like something, don't put it on your tray. But I highly recommend you do things on a per share basis. And then when you're all done, say, okay, per share basis, how many shares are we discussing? How many contracts? I'll show that to you as we proceed. Apple. I got a horse right here. His name is Paul Revere. Can do, can do. Not a song about a guy who owns a horse. It's a song about somebody who's betting on a horse. And so when you go to the horse track and make a bet on that horse, you don't actually own the horse. My friends, they drive me nuts. They really think they own like a football team. I go, you realize that isn't a real football team. That's a fantasy football team. Jerry Jones owns a real football team. You, my friend, do not. Why are you raining on my parade? Apple is the underlying interest, the thing we're betting on. Well, I should say either betting on or hedging, because the 2 players we have are speculators and hedgers. And the underlying interest here is Apple, which is a stock. But the underlying interest could be something other than a stock. And that would be a non-equity option. It could be, a foreign currency. It could be an index. It could be a yield, whatever the case may be. Very testable. I don't know about you, but when I take a test, I like to get to the first thing I actually know the right answer to. I go, all right, hopefully I'm not like 30 deep before there's something that looks familiar to me. And if you miss when do options expire on your exam, I think they ought to just flunk you immediately. I think your chair should shoot you into the ceiling. And they come and say, how in the heck did you know that? I mean, if we tell you you're going to encounter a certain topic on the exam, and when you encounter that topic, you're still not prepared for it, angels weep for you. So options expire on the 3rd Friday of the expiry month at 11:59 Eastern time. That is very much a test question. Now, if you're struggling with strategies, then I highly recommend you spend some time getting all these aim and shoot, point and click questions you're entitled to, right? It doesn't require any analytical prowess to know when options expire. 170 is the strike or exercise price. And then, as we said, call is the type of contract. Right now, Apple, we're looking at a 170 call. And right now, Apple is at 168. When we ask you about in the money, which is synonymous with intrinsic value, when we ask you about out the money and out of the money, we're not asking you about the player. We're simply asking you about the relationship of the market price of Apple, 168, to the strike price of the option, 170. Now, whether that's good news or bad news is an entirely different question. I kind of think it's like when I'm teaching my nephews to play chess. They're grown men now, but when I was teaching to play chess, I say, listen, they say, Dean, how does Uncle Dean, how does this end? I say, well, the event in chess that ends the game is checkmate or stalemate. At the end of this game, either both kings are alive, stalemate, or one of the kings is dead, checkmate. And then my nephew says, well, is that good news or bad news? I said, well, that's a different question. Asking about winning, losing, or drawing, making money, losing money, break even is a different question than the relationship of the market price of the strike price. I say to my nephew, well, checkmate, there's going to be a winner and a loser. That depends whose king is dead. Stalemate is the draw. My former sister-in-law said, well, that's the object of the game, right? Both kings live in harmony. I go, no, that isn't the object of the game. She goes, oh man, that's such a violent game. I go, you're the one that let me play paintball, but I think paintball is much more violent than a game of chess, but oh well. All right, so let's do this. Now, the other thing I would tell you is of this concept, intrinsic value and time value that we're developing, the intrinsic value is way more important. And the reason it's way more important is because they like to say things on the test like, you close out for intrinsic value. And if you don't know intrinsic value, then you don't know how to close it out. What they're trying to do is avoid giving you the premium, is kind of making you work for it, so to speak. It's kind of like how they make you work to get like conversion ratio, by giving you the conversion price. So that one's going to be more important than these other ones that we'll be developing. All right, so intrinsic value, as I said, is more important than the concept of time value, which we'll be talking about. So intrinsic value, we're in the money in a call contract, is when the market price is up from the strike price. If you've been with me any length of time and watched my videos, I always say, and here it comes, if you only remember one thing about options, please remember call up, put down. Call up, put down. Call up is a great memory aid device for what we're discussing, intrinsic value. If the market price is up from the strike price, call up, the contract has intrinsic value. Put down. If the market price is down from the strike price, it has intrinsic value. It's also good for break evens. Call up, strike price plus premium. Put down, strike price less premium. So if you only remember one thing about options, call up, put down. Now, another thing you can do to answer this question about intrinsic value is you can use what I call a framing question. A framing question is a question you ask yourself. Is the contract likely to be exercised? Is it likely, even from a long perspective, we're looking at a 170 call contract. Is it likely somebody wants to buy Apple at 170 when Apple's at 172? The answer is yes. If we answer that question yes, that means the contract has intrinsic value. Now, don't tell me that means somebody's made money or lost money. You can't tell me that. And again, we're not asking that. We're just asking, what is that relationship of the market price, 172, to the strike price? So this 170 call has 2 points of intrinsic value. The premium you're going to pay or receive consists of both the intrinsic value and the time value. And as I said, the time value is not as important as intrinsic value. In fact, I just tutored a guy earlier today, and he was struggling with the question, which was asking him about time value decaying. As we get closer to expiration, the time value is going to dissipate. It's going to disappear. I used to make my baby brokers write 1,000 times. Options are a wasting asset. Time value erodes. At expiration, the option contract is only going to be worth its intrinsic value. If it has intrinsic value, the contract will be exercised. If it has no intrinsic value at expiration, the contract will expire worthless. By the way, I'm hinting that means that when they have time clock questions, they love time clock questions like, you buy the option several weeks later, you buy the option at expiration. I call those time clock questions. And at expiration, I'm under no obligation to tell you what happened to the option contract. We'll practice that. Now, at the money is when the strike price and the market price are the same. And that's important too, because that means no intrinsic value. So if that's an Apple 170 call and Apple's 170 at expiration, that contract is going to expire. And out of the money. This is today's relationship. Today, I don't know where Apple's at. Last time I checked, it was 168. It could be a 167. Test question. Apple is a pretty damn volatile stock as compared to the market. What is the term for saying that Apple has a high level of volatility as compared to the market? It's like learning a foreign language, right? Anyway, you want to put it in the chat or tell us what they think that is? A measurement.
The beta? The beta?
Beta.
The beta?
That's right. That's right. The measurement of a stock's volatility as compared to the market as a whole can best be described as, and you would come up with beta. Oh, by the way, we would expect a stock that has a high beta, the premium would be greater, right? I say, Sarah, if you want me to agree to be a potential victim on a stock with a high beta, I'm going to want more money from you. It's going to be much more likely that you're going to, be able to make me perform on the contract. By the way, volatility, it's not testable. So I'll try and distinguish between the conversation that's, testable and the part that's not. But, volatility is either your friend or your enemy. As a buyer of an option, I'm buying volatility. And I need it. I want it. And if I sell an option, I'm selling volatility. So if we are going back to our matrix, right, in that long call, I'm buying upward volatility. That's why it's very hard to make money in a long option, because I got to be right about three things. I got to be right about direction, long call up. I got to be right about how far up. And I got to be right about the timing. In the stock, I just got to be right about one thing, direction, and I have forever to be right. When I buy a put, I'm buying downward volatility. It's my friend. I got to be right that the stock's going down. I got to be right about how far down, and I got to be right about timing. And then, when I'm selling the volatility, I said, well, you may be right, but I don't think you're going to be right about all three of those things. That's pretty difficult. In my horse race analogy, that's calling the trifecta, right? Calling the number one horse, the number two horse, and the number three horse in the row. That's pretty difficult to do. Okay, so again, we're not talking yet about how do we make money, how do we lose money, how do we break even. That's not what we're discussing right now. What we're discussing is the relationship of the market price to the strike price. And we said if we only remember one thing about our time together, call up, put down. So I'll just put a price of Apple up on the slide here. And let's say Apple right now is 168. And again, I like to think of options as being about floors and ceilings. And with the current market price of Apple at 168, right now it has no intrinsic value. Now, options are about floors and ceilings. As you can see here, there is no ceiling. Right? That's why that market price going up goes up, and up. There's no such thing, by the way, as negative intrinsic value. The contract either has it or it doesn't. Let's say Apple's at 173. Does that contract have intrinsic value? It certainly does, right? Again, we said there's a couple ways to proceed. We could use call up. The market price is up from the strike price. We could use, is the contract likely to be exercised? Is it likely somebody wants to buy Apple at 170? When Apple's at 173, the answer is yes. Anytime we say yes to that, that means the contract has intrinsic value. What is the opposite relationship? What is the opposite relationship? So as we said, call up, put down. So intrinsic or in the money in a put contract is when the market price of the stock is less than the strike price of the put contract. As we said, if you only remember one thing, call up, put down. Call up, if the market price is above the strike price, the contract has intrinsic value. Call up, the break even is strike price plus premium. Put down, if the market price is down from the strike price, the contract has intrinsic value. And when we get there, the break even is going to be strike price less premium. We said you could also use a framing question. Is it likely to be exercised? Is it likely somebody wants to sell Apple at 170 when Apple's at 167? The answer is yes. Wherever we answer yes to that framing question, that means the contract has intrinsic value. And again, we're not asking about making money, losing money. We're just asking about the relationship of the market price to the strike price. That's the at the money relationship. Here, this is out of the money. It doesn't make any sense to sell Apple at 170. You exercise at 170 put when the stock's at 172. I mean, if I were short that put, I was the puttee at 170 and the stock's at 172 and you stuck it to me, I'd say, well, you must be new. I'm here for you. Open all day, so that is put is out of the money. There's no such thing as negative intrinsic value. The option either has it or it does not. All right, so again, here's the market price of Apple. Kind of an important concept, that the market price of a stock, has no ceiling, right? There's a finite supply of Apple stock, potential infinite demand, so there's no ceiling. But there certainly is a floor. Nobody can ever call you and say your stock went to -5, right? I mean, it can only go to 0. And then we said this relationship is put down, right? And so I told you today, last time I checked, Apple was at 168. So the calls are out of the money, but that 170 put contract is in the money. It has 2 points of intrinsic value. Is that good news or bad news? Well, that depends. That's a different question. We're just asking about this relationship. If Apple, we said, goes up and down, the strike price doesn't change, but what does change is the market price of Apple at 172. The 170 puts have no intrinsic value. Now, the premium that you pay or receive, for an option contract has 2 components. It has the intrinsic value, which we've been discussing, and everything in excess of the intrinsic value is called the time value. So the intrinsic value plus the time value equals the premium. Now, of those 2 concepts, I told you the one that's most important on the test is this idea of intrinsic value. Because they like to say you close it out at intrinsic value, or what is the intrinsic value? So, time value is an option. That's going to go poof. Time value is going to go poof. Now, one thing we should understand here is that if you want me to be obliged for a longer time frame, I'm going to want more money. Longer term option contracts always have greater premiums. So here, if we're looking at an Apple 170 call at 9, so you say, Dean, give me a quote on an Apple December 170 call. I punch it up on my quote screen. I say right now, the Apple December 170 call is trading at 9. Apple's at 72. So as your broker, I say, Philip, you're paying 2 points in intrinsic value and 7 points in time value. As we said, I think of it, again, what Dean thinks is a decimal. I think of time value is everything in excess of the intrinsic value. And you say, hey, Dean, what's the price right now? You just told me it's 9, I get it. But what's the price on a December 165 call? I say, well, having a choice to buy at 165, Philip, is more desirable. So I don't know what it is. I'll punch it up for you, but it's going to be more than 9. You see, Dean, what's the quote on a December 175 call? I say, well, buying at a higher price isn't it desirable, and that'll be lower. An important concept for us is to know that lower strike call contracts always have greater premiums. Lower strike call contracts always have greater premiums. It's not so important today, but if you go on to advanced option strategies, it'll be important. And here we say, let's look at this put contract. It's a 170 put, and right now there's no intrinsic value. So I say, Susanna, if you want to quote on the Apple December 170 put, it's 9. And right now there's no intrinsic value, so you'd be paying 9 points in time value. She goes, well, Dean, what if I wanted to establish a choice to buy at 175? I said, well, Susanna, a choice to buy at 175 is going to be more desirable. It's going to have a greater premium. So I have a mantra that I want you to know. This isn't important unless you're going on to, if you're Series 7. If you're joining us and you're just taking an SIE, who cares? But if you're taking your 7 or you're taking an SIE and going on to 7, then this is important. The mantra is lower, higher, longer. Lower, higher, longer. Lower, higher, longer. Lower strike call contracts always have greater premiums. Lower, higher, longer. Lower, higher, longer. Higher strike put contracts always have greater premiums. Lower, higher, longer. Longer term option contracts always have greater premiums. Listen, if you want me to be a potential victim, if you want me to short an option contract, and you want me to be a potential victim for technically 39 months, but up to 30 months in practice, wow. What kind of premium would I want for that? Big time, right? So we have long-term equity appreciation potential security leaps that go out to 30 months. Woo! How might I test you on that? I might say, which one of these 170 calls is most likely a leap? And it would have the one that has the huge premium. The huge premium. Now, I'm not asking what can happen to you. What can happen to an Apple contract? So every question on the test is going to end with either the contract got traded, the contract got exercised, or the contract expired. A good way to remember that memory aid device is T. The option can be traded, the contract option can be exercised, the option can expire. Right? So if you're going to trade the option, you're going to do a closing transaction. I say, what do you want to do with this Apple 170 call, Philip? And he says, I'd like to trade it. I said, fine, because you can exercise if you want. He said, I don't want to do that. I want to do a closing sale. And test question, closing sales are used to eliminate or reduce or offset a long position. And that's certainly something he could decide that he wants to do. Right? I call my broker and I say, hey, I don't want to be obliged anymore. So I could do a closing purchase. A closing purchase is used, test question, to eliminate or reduce or offset a short position. Because I said, I'm hoping that at some point you can get good at tracking money. Right. So if Dean goes to the casino and I do an opening purchase for $2,000 worth of chips, opening purchase, and at the end of the evening, I go to the casino to do my closing sale, and it's $3,000. I made $1,000. And if I do an opening purchase at the casino for $2,000, I cash out my chips and I got $1,000, I'm going to lose down $1,000, right? So if you can track money, which we haven't done yet, we're getting there, and you can do contract specifications, you get all the options right. Now, if at expiration, a contract has intrinsic value, if at expiration, an option contract has intrinsic value, it will be exercised. So, Philip says, oh my God, it's the third Friday and I own that Apple 170 call and Apple's at 182. I can't believe I forgot to call Dean and exercise my option contract. I say, Philip, in your option agreement, we told you if we didn't hear from you that we would have limited discretion to exercise that contract for you. I mean, why would you not want us to do that for you? Now, the customers who get, upset about this are the people short. They go, oh, maybe the guy who's long will forget me. I go, no, if you're short an option and it has intrinsic value, it's going to be exercised. Now, the other point here is I don't have to tell you on the test whether the contract got exercised. In other words, if I tell you it's an Apple 170 call and I tell you at expiration Apple's 182, you should know that if the market price is north of the strike price call up, it's getting exercised. Or the last thing that can happen to an option, it can expire. If at expiration, the contract has no intrinsic value, the contract will expire worthless. Warning, I'm being a jerk. The test isn't going to give you warning that they're being a jerk. If the option contract expires worthless, is that good news or bad news?
Bad news.
What's that?
I would say bad news because it's a wasted premium.
Well, it depends, Philip. You assumed that you were long the option contract. I didn't tell you that. Gotcha. I even warned you I was going to be a jerk, right?
You're
If
right.
I had said, Philip, that you were long the option contract expired worthless, you would have been correct to say, I'm unhappy.
You said that. Yeah.
I did. I don't think I said that. I said, if
No,
you
at the beginning, you said it
oh,
doesn't.
okay. Well, just be careful, right? Because if I'm short, that's going to be good news. That's going to be good news,
Yeah.
right?
Okay, got it.
All right. As we said, if you're struggling with, the strategies and so forth, make sure you get all this kind of stuff that you're entitled to. And this is very testable, this sequence. A good memory aid for this is Dado 15. So a good way to remember this is Dado 15. And it's very testable to know this sequence. So, we haven't done any trades yet because in terms of my presentation, we have not yet opened an option account. And we can't do any option trades until we've actually opened up the account. Once we open up the account, then we're off to the races. But So I'm going to give you an OCC disclosure document. That's the D. It's called the characteristics and risks of options. Boy, characteristics and risks, no rewards. This is all the bad stuff that can happen to you. You know, my casino analogy, I always think it would be funny, right? When I'm at the casino, it's kind of fun because you can tell the people who are maybe newer than other folks. You know, and I always think, wouldn't it be fun if it was like our business and we said, before you gamble, let's give you a gambling disclosure document that tells you all the bad things that can happen to you this evening. You know, let me see if I can get my gambling principal to sign off and let you do some play some Keno or bingo, cards and dice way north of where you're at right now. And I joke, they not only do not do that, we say, hey, let's give you some adult beverages to help you with your math and your judgment skills. You know, that's on us. You know, you don't even have to pay for that. So our business is a little different. So I'm going to go back to my registered option principal, Larry Tesselman, and he's going to say, Dean, did you give the customer the disclosure document? I had better say yes. And so he says, okay, I'm going to approve it or her. So I call you and I say, hey, I got your account approved. Dat 015, disclosure, account approval. Now we can do our first trade. So we can do our opening purchase. Usually opening purchase is going to be a lower level of approval. It's easier to get you approved to buy options because when you buy options, if you buy a call or you buy a put or you buy a straddle debit spread or, you know, and you're wrong, you just lose your money. So it's pretty easy to qualify somebody who wants to do, you know, opening purchases. We basically say, is this the kind of money you can afford to lose? You know, for everybody, that's a different number, but Philip said he was going to be upset. He's right. If he's long that Apple 170 call at 9, he expires, he's going to lose $900 on one contract. But if he complains, I'm going to say, well, Philip, I made it pretty clear to you that if you buy options and you're wrong, you're going to lose your money. Now, this shouldn't be your rent money. This should be your speculative money. Now, I say, now that I have your account approved, we've done our first trade. I say you have 15 days from the account approval. That's the O option agreement. 15 days to get back to me the option agreement that you read that disclosure document and you understood it. Because later when you go south on me, I'm going to say, well, wait a minute. You said you understood this. Now, if that is late, you have 15 days from account approval. If it's late, I'm only going to let you do closing transactions. So the 15th day has come and gone. And, I call you and you say, hey, Dean, I'm so glad you called. What a coincidence. I need to buy some NVIDIA puts. And I said, well, no can do. The reason I'm calling you is because the 15th day has come and gone. You said, well, Dean, yeah, I know it's fit from the bottom on my desk. I just haven't got it to you yet. And I said, well, sorry. Until you get that to me, all you can do is get rid of the stuff you got. You're not going to be able to do anything new until you get back to me that document. Okay, so as we said, once the account's approved, we can do an opening transaction. It's going to be a higher level of approval to get you approved to do opening sales than it is opening purchases. But as we said, these are our 4 types of orders. I would be looking for this as an answer set. And I don't know if any of you have been watching any of my videos, but anytime I get an opportunity to share this answer set with folks, I do so because it's definitely there. It's on the SIE, it's on the Series 7, and we would just call this A, B, C, D, right? And then depending on what I'm asking you, will depend on the right answer. Here is an example as I really love, and I pulled this from the SIE practice exam. I pulled this right from the FINRA practice exam. This is good, I think, for not only the FINRA practice exam and the SIE, but for Series 7 as well. So a transaction in which a writer, again, is like learning a foreign language. You need to know that writer means short. You wrote the contract. I, Dean Tinney, agree to sell 100 shares of Apple at 170. So that means I did a opening sale. And so how do I get rid of an opening sale? How do I eliminate, offset, or reduce my obligation to sell or buy? By the way, I'm just now looking at the question. It doesn't tell us what type of contract it is. So I'm not even sure I have an obligation to sell the stock if I wrote a call or an obligation to buy the stock if I wrote a put. It doesn't matter. If I want to extinguish that obligation, I would do which of the following. One of my favorite basketball players of all time is a guy named Chris Dudley. He played basketball at Yale, not a hotbed for NBA talent, but he played center. And then he signed a $10 million contract with the Knicks. I, Chris Dudley, agree to play center for the New York Knicks for $10 million. That's the opening sale. He wrote the contract. They both agree it's a bust. And so he says, hey, listen, we agreed this isn't working. How about I do a closing purchase for $2 million? I'll buy back my contract. And the Knicks said, sounds like a deal. So he did an opening sale for $10 million, closing purchase for $2 million. I think he's got $8 million left over. Now, if you ask him how he became a millionaire, I'm not sure if he said he was a professional athlete or he says, I sold a contract high, I bought a contract low. The good news, he's a finance major, so maybe it dawned on him to say, hey, there's still a way for me to get out of this. Here, the answer is B. The way we get out of a short option position is by doing a closing purchase.
That was
And
my
a registered option principle, that's my favorite transaction. That's somebody who has an obligation going on.
closing purchase.
Right, closing. By the way, that says cover means closing, right? So there's a lot of different language here. All right, so the option contract can be exercised. We said T. And, Philip says, well, Dean, how do I know if I exercise my 170 call contract that somebody's going to deliver 100 shares of Apple to me? I said, well, that's a good question, Philip. I said, how do they know that you're going to come up with $17,000? I said, what you're asking me about is what's called contraparty risk. The risk that when you're trading options and you exercise, that you're not going to come up with the money or the stock. And I say, test question, no worries. The OCC test question is the issuer and guarantor of all option contracts. They stand in the middle and make sure that everybody who's doing this, trading this game, is going to, make good. I got a joke. It's like, why do you want to gamble in Vegas? Because we have a gaming commission, and if you win and take that ticket to the window, you're going to get paid. Okay, so if you're long a call and you exercise, you're going to have to pay for the stock. So you're going to need money. In my Apple example, if Philip wants to exercise, I'm his broker, his Apple 170 call, he needs 17 grand. The option contract settled T+1, but the resulting stock trades are T+2. Public service announcement before everybody starts panicking. We're coming to you from, Videos Live Forever. April 17th, 2024. And settlement is changing in May. It's moving from T+2 to T+1. Listen, I'm dating myself. When I came in the business, it was T+5. Can you imagine that? And every time we move it back, people freak out. I go, no problems. I've been here. We've done that. The world is not going to fall apart. By the way, it makes it easier for us not to worry about contraparty risk, right? The quicker we can settle up, the quicker I don't have to worry about you not making good. So we're on our way, I think, to a day, someday of real-time settlement. Anyways, back to the test issue. Whenever anything changes, what they do at FINRA is they remove the questions from the Q bank that are now dated questions. It takes them months. It took them almost a year to change the RMD from 72 to 73. So they remove all those questions about 72, and then they reload months later, and then it says an experimental question. In other words, they won't even count until they put it in there, and the majority of people are getting it right. Then once again, it becomes testable, kind of like RMDs at 73 now. That is now a testable number. But when it went from 72 to 73, oh my God, it took them forever. And everybody was freaking out, going, whoa, I go, whoa, relax. So if you are watching older videos and guys like Dean are saying T+2, don't freak out. All right, if you're short the call, you're going to have to deliver the stock. By the way, I'm more worried as a margin clerk about somebody has to deliver the stock. Money is a definable thing, stock not so much. So as a margin clerk, I want to know, where is that stock? And if I call you and I say, hey, you got exercised on the short call, and you say, Dean, I choose not to be exercised. I said, well, gee, you're confused, my friend. You don't have a choice. You have an obligation. You said, well, Dean, what if I had the stock in my account? I said, if you had the stock in your account, I wouldn't be having this conversation with you right now. I would have just delivered it. And you said, well, Dean, do you know where I can get this stock? I go,
Gotta
yes.
borrow it.
Every day between 9:30 and 4 o'clock, there's a market where you can get the stock. So there's a distinction between somebody who's agreeing to sell stock they own, a covered call, and somebody who's agreeing to sell stock they don't own, a naked or uncovered call. Along the put, you got to sell the stock, so you're gonna need the stock. You said, Dean, I'm exercising my put. I'm going to stick it to somebody. I said, okay, well, we need the stock. And then your point, Philip, I could borrow the stock perhaps. I would want to check with my brokerage firm because that's not the normal thing the broker is going to do. I had some 40 puts, Philip, that I was going to exercise. I said, you know what? I bet anything my broker is going to buy that stock at 32 and stick it to somebody at 40. And that's not what I want to do. So I need to find out what their option order handling practices are. And I said, no, that's not what I want to do. I want to borrow 100 shares at 32 and stick it to somebody at 40 is what I want to do. That's how I want to proceed, right? So short put, you need money. You need money, right? You got to pay for the stock, right? So if you're a short the put and somebody sticks it to you, you need the money. Well, we're almost ready. We got our account open. We're getting ready to play here. We have test question 2 styles of option exercise. We have American style, European style. American style presents more risk to the person who's short the option contract because in American style test question, you can exercise anytime you'd like. So, I was afraid, don't tell anybody, I didn't have 20 grand at the time. But I was afraid by the time I came up with 20 grand, the stock would move against me. It's a $20 stock. I did have $2,000, so I bought 10 of the 20 calls. So that gives me a right to call away 1,000 shares at 20. They were October calls, but I got the money in September and I exercised. I could do that. I know the guy who sold the October is going to be shocked when he gets the exercise notice. He goes, what do you mean? It's in October. Well, you didn't read the OCC disclosure document. Well, American style means the holder can exercise anytime. Very testable. The OCC assigns exercise notices randomly. So, when I exercise that, my broker contacts the OCC, then the OCC is going to contact a broker dealer. There's lots of broker dealers have somebody who's short that particular contract. They contact Merrill Lynch. Merrill Lynch says, why us? They say, you must have missed this on your Series 7. It's done randomly. Now, within Merrill's client base, they probably perhaps have more than one customer who is short that particular contract. And test question, the broker dealer can do it randomly, FIFO, or another fair method. I can't think of one. Drawing straws, no. Rock, paper, scissors, no. Okay. Now, what we mean by you can't be discriminatory is I can't say, oh man, that's my good customer. I want to do it to him. I can't say, oh, there's that jerk, man. Let's stick it to him. No, right? So whatever you're doing, you have to tell your clients, you have to tell the OCC, and if you change it, you have to tell everybody.
Disclosure.
Always sunlight's the best disinfectant, right? So European style test question is typically for non-equity options. I gave you an example of European style. I don't know if you caught it, but remember, I couldn't just show up anytime and stick the car to the dealer for 60 grand. You didn't have to worry during the term of the lease, me showing up with that car. It was only at the end of the lease that I could show up and say, hey, where's my $60,000? Right? So that's European style. That has less risk for the person who wrote it because they know that, they're not going to have to perform until the end. Index options test questions settle in cash. Nobody would trade with you. If I had to deliver to you 100 shares of 500 stocks, nobody would trade with you. So, if I'm short an S&P 500 index option, we agree that if you exercise me, I'm not delivering the index. I'm going to deliver the cash. Now, remember, that's different than equity option because in equity options, you actually got to deliver, right? So here it's cash settlement. The seller owes the buyer cash equal to the intrinsic value. That's what I got to come up with. I don't have to come up with the index. And both the index option and the resulting exercise are both T+1. I think a couple of you ladies, I think were in my Series 7 class this week. Were you not? What do you
Yes,
do?
I was.
Do you like, Suzanne? You like my slides better than Kaplan's? I do.
Yep.
I
Yeah, I
do.
like them better.
My slides are target rich, man. We got
I
lots of
keep
questions.
screenshotting them because I'm like, oh, I need to print this.
Well, I'll tell you what, I don't usually do this, and don't tell anybody. If you're listening in video, do not ask me to send you the deck. I'm not going to do it. For those of you who are in the class, I'm more than happy. Just send me an email. I'm more than happy to send you this deck.
Oh, thank you.
You're welcome. Now, remember, I'm really, really trying to hold it together. I'm really busy. So, make sure you tell me your test date. And, I think I'm technically literate enough to do this in a couple minutes and not take the whole day trying to figure out how to do it. Anyways, let's try one. I like it. So what I do is when I find good questions on the FINRA practice exam or Kaplan, I like to, take those because I think they're pretty good questions. And again, this is a question that would be fair game, not only on the SIE, but also on the Series 7. Upon expiration, all in the money S&P index call options are settled by the delivery of which of the following. I love this, very much a test question, right? It's cash. It's cash. All right, well, we're finally ready. We're finally ready to play the game, right? So we're getting ready to trade some options here. One of the common threads is that if you buy an option, as I mentioned earlier, it's pretty easy to qualify you. Is this money you can afford to lose, right? So whenever we buy an option, we buy a call, we buy a put. That's what we're going to be doing this evening. Later on, we buy a straddle, we buy a spread. The worst case, you're going to lose your money. Contract or contracts expire, you lose your money. Tonight, we're going to short a call, we're going to short a put. Moving on, whether you short a call, short a put, or you short a straddle, or you short a spread, credit spread. The best case is contract or contracts expire worthless and you keep the money, neener. That's what we mean by saying that options are a zero-sum game. When that dawns on you, you have half as much to lose, or half as much to learn, I should say, right? One person's options dream is another person's options nightmare. There are games that are win-win where both parties can win. This isn't one of them. This isn't one of them. So we said this is what could happen to an option contract. Basic options. So we finished the intro.